We are talking to you on a day when, in general, the markets are looking slightly puffy-duffy. We've seen an extended sell-off in global markets and commodities are leading the decline. What do you make of the global setup? Are we in for a hard second half of this calendar year?
Good question. I think I'll take it in two parts, the answer. I think the global markets are waiting for various risk events to play out. The big risk event is the US election and how the US behaves in the run-up and what kind of policies are unveiled post the election of the new president. So that is a big event. I think the markets, therefore, globally will remain very choppy and volatile till the elections are concluded and maybe even later. As far as the Indian markets are concerned, we are in a zone where earnings growth has essentially stabilized. We would not definitely see major earnings surprises going forward for the next 12 to 15 months. India has to continue to grow steadily and continue to outperform the markets. In that situation, the underlying trend for the Indian market will be decided by domestic flows. If domestic flows are stable at the rate at which we are seeing them for the last couple of months, Indian markets should hold up. But definitely it will be buffeted. The Indian markets will be buffeted by what's happening abroad. And I definitely see risk coming in from global markets.
Everybody is of the view that it is liquidity which is driving markets up. It is not fundamentals. But when I have this answer, the second follow-up question is that liquidity is coming for a reason. Should we focus on the first part, which is liquidity, or should we focus on the second part, which is reason?
I think we should focus on both. The reason is the fact that we are seeing a change in habits, investment habits. So that's something which is real. Now, investing habits for a long time have been focused on bank deposits. Bank deposits are now difficult to come by for banks. And therefore, clearly, there is a change of habit underlying, which is the reason why liquidity has happened. Which is if you remember the phrases I used in my first answer, I said, if things are stable at the current level of liquidity coming in from domestic savers, the markets will definitely hold up and going forward. Do we see a step change in that? Whether a big increase in fund inflow from domestics or a cut, impossible to tell. But if there's any change in a broader psychology of this market, then that can change. But I'm not going to bet on that. I would expect domestic liquidity to continue to come through, and the expansion which we are seeing of that coming through in IPOs and all the issuances which are happening continue. We would not see so much selling by multinational promoters and offer for sales, which we are seeing if valuations were not very, very rich. And that's something which is unavoidable given this stage of the market.
Okay, valuations are rich, but perhaps this liquidity flow, especially from the domestic participants, can really continue. Sandeep, hi, this is Anisha joining in the conversation. Wanted your take regarding financials, because with the rate cut cycle, there is that worry of what the impact on ROAs and NIMs is going to be. We've already seen, cuts on target price of SBI from 3 or 4 brokerages in the last 1 week itself. They were underperforming as it is. What's the next 6 to 12 months going to be like for large private banks?
Large private banks will be placed better than public sector banks. That's a given. What needs to change is two things. I think we need to see some rate cuts coming in India. Those rate cuts don't seem to be coming immediately. The Fed will definitely be more aggressive in cutting rates in the US than I expect RBI to cut rates in India. We could see a rate cut maybe next year, post the Fed budget. So that's where it is. The other thing which needs to improve is that government spending, and government should run down their surplus cash balances. Overnight liquidity, which has already improved, should continue to improve, and rates, short-term rates can fall. If that happens, that would be good for private sector banks. But in the next 6 months or so, I think private sector banks will be range bound and unlikely to be driving the market further. That's what I see.
Sandeep, I'd like to draw your attention to the word capex, and again 2 parts to this question. One, which is driven by the government capex. defense, railways, shipyard. Where is that space headed? Second part, sectors which are driven by private sector capex, which is largely industrials, mechanicals, the entire cyclical space. In the light of government sector capex versus private sector capex, how do you see these sectors moving?
So I was with L&T this last week, and if I look at the capex numbers, as you correctly point out, there's public and private sector. I think the real challenge, public sector capex at the central government level should pick up. Now the elections are behind us. All the data which is coming through is that government spending is increasing. So that will come, that will definitely pick up. But we should remember that now the real driver should be state governments. State governments actually control a lot of capex. At that level, there's significant financial devolution which has happened in India. And we need to see that come through. And state governments itself, they don't have operational finance commissions. They need to devolve further to districts. So the financial, financial independence of and financial empowerment of lower levels of government, which are local bodies, and should definitely, if that happens, capex at the state level will actually pick up. Unfortunately, the state finance commissions are non-operational most of the time. We see the center financial commissions actually meet regularly. Some of the state finance commissions are not even constituted. So, long story short, we should look at state capex in addition to central capex. And all the sectors that you mentioned are mostly driven by the center, and that capex cannot only be the driver for capex in the country. On private sector capex, this is something which will have a much slower pickup than most people expected in the run-up. I think some of the structural changes which have happened in India, essentially the fact that promoters cannot now borrow indefinitely from banks and still be bailed out and still keep the assets or strip value from the businesses. NCLT and the proceedings in law which happen against promoters now make promoters more wary of going and binging on capex than it has been. The memories of what happened after 2011-12 in this country, which saw an extended pressure on the private sector, both in terms of banking and legal aspects, I think it's still fresh in the mind of many promoters.
All right. And, speaking of capex, just wanted to also get in your take as to what the outlook is when it comes to consumer discretionary and the entire basket, and how you're looking at rural recovery as well playing out and being a key trigger. Do you see that happening?
So I think rural recovery is a often repeated and often anticipated event. I would think that the rural recovery will come through, but will be not as strong as most people would want it to be. So it's on a positive side. The monsoon season is concluding. Patches of it have been good. Patches of the country have not seen great rainfall. So it cannot be a negative factor, but it will not be an overwhelming positive as far as rural recovery of consumption is concerned. Festival season, we are at the cusp of a big festival season. With Ganesh Chaturthi starting on this on this weekend. So in the run-up to that, we will soon know by November where we are, but it will be a moderate pickup in my view.
So I am going to take a leap from your last answer, which is that a lot of Indian promoters are still not very convinced about the way how they want to commit to capex. If that is the assumption, then what happens to these valuations in some of the cyclicals, industrials and machinery companies? I'm talking about the Siemens, the ABBs and the Thamaxes of the world, because they've also seen what could be called as an extraordinary spike in their underlying asset prices. P multiples have gone to 50, 60, 70. Could there be a case that private sector capex does not kick in, second half markets get disappointed and these stocks, they move into serious time-wise and price-wise correction?
I think after 30 plus years, I would say that it's impossible to pinpoint what exactly will go wrong and when it will go wrong and to what extent. As I said in the very beginning, valuations remain rich, liquidity remains very positive, growth remains good, though not accelerating as it was accelerating, let's say, post-COVID and for the last 18 months. So we are now in a stable earnings growth, GDP growth plateau, which is still a good number at 7% GDP growth. So I wouldn't expect a major correction driven by crisis or of any kind. It is essentially a combination of what will happen outside India, and I pointed out initially that there are significant risks globally. We have been able to maneuver through these risks over the last 2 years, despite all the conflicts which have started around the world. And even India's neighborhood, the risks are increasing. So I would expect those risks to come through from outside India rather than within India per se. There are some elections around the corner in important states such as Maharashtra. So those elections also need to be monitored and could have an impact. But I don't think the underlying domestic sentiment for investing in the equity markets changes, because it's taken more than 2 decades for savers to start looking seriously at Indian markets and investing in forms of SIP. So that will not change. That's a habit forming thing, something like reading a daily newspaper in the morning. And once that's set, it is set at that level. So I wouldn't expect a major correction unless there are significant global events which are negative.
Expecting a significant correction. But Sandeep, what's the view on autos? Today, of course, is the World EV Day, and we'll be deep diving into that. But separately, there have been these increased clamours of increased discounting, the inventory level being high, and plateauing of sales a bit. Do you think perhaps there is a peak of the stock prices also that has been made in the auto sector?
I think auto sector saw a strong rebound, and again, what we are seeing is plateauing out. As I said, most things are at a good level in India and are plateauing out at that high level. Definitely, I think there is discounts increasing in the auto sector. I would still think that we broadly are in a zone of volume growth in the region of 5 to 6% for the auto sector for the next 12 to 18 months.
Sandeep, so let's start breaking down autos now. Within auto, the mega trend is EV, then it is SUV, and then what is happening essentially in this entire so-called luxury market. Which end of the market, to your mind right now, is the exciting one?
Exciting one could be the luxury market, actually, because there's been significant capital gains that Indian investors have seen. So that is one end of the market, and that luxury market need not be at the 50 lakh plus kind of price range. It could be 30 to 40 lakhs plus, and that is still significantly higher than the average selling price, 3 times almost. The increase, 30 lakhs is almost 3 times the average selling price of cars in this country. So that is the exciting part. In terms of the SUV and the EVs, EVs may take a bit of a breather in the near term. SUVs, and that trend should continue. Actually, most of the new launches are also in the SUV. So, that's where the action is, that's where the new product launches are, and that's where the consumer attention is.
You note, in next 1 year, you expect materials and financials to outperform. Similarly, you expect utilities and industrials to underperform. So let's understand the thought behind materials and industrials. Why do you expect materials to outperform and industrials to underperform?
So I think, what the view... Sorry, can you come again? Can you repeat the question?
What I have, and I'll repeat it again, and this is the data what I have. Sector which will outperform relative to the market in next 1 year, the Macquarie note says materials. And sectors where there could be a reduce or there could be underperformance, it is industrials. So I'm just trying to understand the differentiation here.
I think materials is essentially driven by the China view. So this is something which our view is that China should be able to broadly stabilize, though it will be at a weaker range. So that's where it is. Indian material demand will remain fairly strong. So that's something which is there. Industrial essentially is about valuations. As you also pointed out, a lot of capex-driven companies have seen valuations go up. So it's more conservativeness on valuations and how much they can go up. As long as earnings growth is at the level and is not increasing, and there are no further big surprises, which is unlikely to happen, valuations will come in and will become a barrier for stock performance.
In light of where we stand in terms of the global macros, local micros, interest rate curve, where do you think that for next 2 to 3 years you see decent earning visibility, and which are the themes or sectors which you think that are both on a relative basis and an absolute basis will outperform? Where do you see 2-3 years of decent earnings visibility based on today's understanding of the world?
Earnings visibility essentially will be primarily in the domestic sector. So that's where we see that's where we'll see some stability. India should maintain at least a 6.5% GDP growth, at least a 10 to 11% earnings growth in nominal terms, and therefore the domestic-driven sector, domestic consumption-oriented stories should at least see earnings visibility. But you have to overlay it by valuations, and some of these stories are very rich in valuations, and to that extent that will be the issue. But if to answer your question, earnings visibility is the highest in domestic-driven sectors, in consumption-driven sectors.
What do you believe, Sandeep, is going to be the next big trigger when it comes to the Indian markets in terms of priority, or what would likely to be the key factor on investors' mind when looking at the next trigger for the Indian markets?
In the short term, the next trigger would be the election results in Maharashtra. We would also see Delhi go in for elections next year. So some of these election results will play out. I think state politics and state elections will be important triggers in the near term. In terms of the broader market, once we have the settlement of the US elections, and hopefully we have an outcome which is not unsettling or which doesn't create further political uncertainty in the US and globally, the interest rate cut cycle will play out. So those are the two factors, in my view, which will be near-term triggers for the market.
So let's wrap it up with one big moving part, which is that post-COVID, we've actually seen an exponential jump in interest rates, both globally and locally. Now we could be staring at a reversal of interest rates. If interest rates come down, which could become the first port of call? Could it be NBFCs? Could it be high leverage companies? Could it be, high growth companies? Where do you think the market migration will happen because of this interest rate adjustment?
If the interest adjustment is smooth and there's no other, there is no pressures coming globally, because this interest rate adjustment also, we have seen anytime there's large moves in interest rate, either there's pressure on currency or elsewhere. The other incipient pressure which is happening globally is the huge fiscal deficits that the US is running at over 6%, and they continue to run. Even post the election, the anticipation is it will be no tax and all spend kind of policy in the US. So assuming that there are no disruptions or lack of confidence coming through reflected in the currency markets, the biggest beneficiary will be the rate sensitive sectors, and therefore it will be NBFCs and private sector banks. I would think this is where the benefit will be. But as I've been highlighting all through this conversation, there are significant global risks, especially with the US election and events surrounding that.
Well, fantastic to have you on ET Now. Certainly hope to see much more of you going forward. It's been almost like a 1-year wait, right? Let's book your next appointment, Sandeep Bhatia, right now, so that we don't have to wait for another 1 year.
Definitely, we'll be in touch with your colleagues.